Hi, everybody, and welcome to Macro Markets with Guggenheim Investments, where we invite leaders from our investment team to offer their analysis of the investment landscape and the economic outlook. I'm Jay Diamond, Head of Thought Leadership for Guggenheim Investments, and I'll be hosting today. We are recording this episode on Leap Day, Thursday, February 29th, 2024. Before we begin, I want to thank our listeners for tuning in and remind you that if you have any questions for a podcast guest, please email us at macromarkets@guggenheiminvestments.com. And at the end of today's podcast, I'll be reading a question from one of our listeners for Karthik Narayanan, our head of structured credit. He was a guest on our last episode, and I'll read his answer. I also want to mention some good news that hit the tape today. Guggenheim Investments was named by Barron's Magazine as number one out of 49 fund families in the taxable bond category for 2023 based on manager performance. It's the second time in 4 years in which we've come in number one in this highly competitive ranking. So congrats to all of our investment professionals responsible for our fund performance, including our guests today. And thanks to all of our investors for your trust in us. Okay, let's get right into it. Our topic today is the investment-grade corporate bond sector. After treasuries and agencies, investment grade is the largest of the fixed income universe and a mainstay of fixed income investing. There's been a lot of activity in the sector recently, and here to tell us all about it is Justin Takata, head of our investment grade sector team, and Maria Giraldo, strategist on our macroeconomic and investment research group. Welcome back, Justin and Maria, and thanks for taking the time to chat with us today.
Oh, thanks, Jay. Good to be here.
Yeah, I'm excited to be here, Jay. What a perfect timing to talk about investment-grade bonds given our Barron's ranking.
Exactly. Well, to dive into it, let's discuss some of the major themes that are in the investment-grade market today, which we're going to be calling the IG market throughout, so people get used to that. But Justin, what are some of the big themes that you are seeing?
If we kind of divide the investment grade bond market into at least two kind of topics, one would be the primary issuance, which is where corporate bond issuers raise debt and capital for their companies, and we as investors buy that debt. And of course, then what we do or what we're seeing in the secondary market with trading flows in demand there. On the primary side, there's been a very robust start to the year for primary issuance, which I think is very topical. But on the other side of that, demand for that issuance and in the secondary market has been extremely robust as well. And so we can talk about further in this podcast about the dynamics of how that affects the market, both supply and demand. We can talk about fund flows as well and general flows in the market. And I think it's pretty interesting what we've seen so far this year, whether it be mutual funds or ETFs or just regular secondary cash trading. I think that's really started to influence what we've started to see in credit curves, whether they're flatter or steeper. And so I think that's been extremely topical as well. I think finally, if we take a step back, where we are historically in both spreads and yields is extremely important for some investors to kind of take notice of. And I think we can highlight that in some examples and put some numbers to that.
Great. Thanks, Justin. Now, Maria, what are some of the big themes that you're watching develop?
So as part of our macro group, I would say we're focused on much more sort of higher level topics, like we're looking at the balance between an economy that for us looks like it's still signaling these end of cycle indicators that would normally suggest that we're heading into a recession, but then we're balancing that against what we're seeing in corporate credit fundamentals, which in aggregate look actually pretty good. Then separately, what's happening with credit flow and bank lending. By design, the Fed's tightening cycle was meant to slow the flow of credit, which to some extent happened last year. But now we're seeing signs that the worst is behind us. So what are the implications for that to the economy? We're keeping an eye on emerging bifurcations in the data that suggests that even if we do avoid a recession, that's not going to be the story for everyone. And then finally, what does this all mean for the Fed easing cycle? The market is highly anticipating the start of rate cuts. And so we've been thinking a lot about what the implication is for interest rates over multiple horizons, whether we're looking at now to the end of the year, next 2 years, or even the next decade.
Justin, let's dive a little deeper. What are you seeing right now in supply and demand for investment-grade corporate credit?
When we think about supply and primary issuance, it's been absolutely a phenomenal start to the year. On a gross basis, issuance is up about 30% year over year. A lot of that's attributed to a decent amount of pent-up M&A financing that was either brought over from last year or even pulled forward from this year. And then we're also seeing just outright issuance pulled forward, given how tight spreads are. And just to kind of frame that out, as we've rallied so far this year, earlier in the year, both in rates and in spreads, that really sometimes gets issuers off the bench and encouraged to issue debt. That being said, I think, a lot of that debt that gets issued is more the 10-year and shorter maturities, as those issuers really believe in this lower rate story further out this year with rate cuts, which Maria will discuss. So they're sticking to shorter maturities instead of locking in that longer 30-year type fixed coupons, right? So that's definitely making them a little bit more reticent as of now to issue further out the curve and lock in those higher rates within their capital structure. I also think it's the robustness in the primary supply so far this quarter. Even though it has been, up 30% year over year, we really expect it to be reasonably flat by the end of the year versus 2023. So just to level set there, we had around 1.2 trillion last year, and we're expecting the same amount this year. Now, these numbers I'm giving you are really based on gross issuance, but net issuance, that takes into account maturities, bonds that are maturing and coming due, and or liability management, which is tenders, right? Where companies that try to retire their debt early at what are attractive levels to them. Now, when we take into account these types of actions, maturities and liability management, we see issuance actually being down 20% on a net basis year over year. So what does that all mean for demand? So just at a very high level, if you have 20% net less bonds to purchase and your demand stays very constant year over year, you naturally think that spreads could tighten, or it's at least going to create a very supportive environment for credit spreads. And that's what we're seeing so far this year, as I think everyone sees these estimates. And again, although robust supply starting early in the quarter, taking this opportunity to add that exposure. And so what does that demand look like, right? And so we're really getting demand from every kind of facet or investor base you really can within the IG market historically. So first of all, we can talk about passive demand. When you think about passive demand, think about mutual funds and index funds. They've been extremely active in the secondary markets, and they're buying outright cash bonds. And hedge funds and macro funds are also involved in these strategies. They're really using ETFs, exchange traded funds, and other derivatives to express their view on the market. And I would say that there's definitely a bifurcation on whether they're bullish or bearish, but either way, at the end of the day, I think it's more important that they're using ETFs. The demand also from traditional buyers, such as insurance companies and pension funds, has also been in that long duration cohort. The demand from both passive and active investors has been extremely strong, and that's really supported the spread performance we've seen so far this quarter. And that's coupled with what arguably will be negative net supply by the time we get to the end of the year.
Just to follow up, what are you seeing in flows right now?
The interesting thing is, even to go back to call it mid to late October, kind of in the middle of the fourth quarter last year, when we started to see very steady inflows into investment grade funds. And so as of last week, we've had 17 consecutive weeks of inflows into IG funds, right? Really averaging about $6 billion per week. And that's going to create and support a really strong technical for spreads. ETFs have become a bit more tactically driven, whereas I think mutual funds are really investing that money as they get inflows, really looking for cash bonds or potentially some type of cash bond substitute while they wait for, say, primary issuance or the right opportunity to buy cash bonds. But that mutual fund flow has been extremely consistent and will be directed into those investment grade corporates, which again is going to be very supportive of credit spreads.
Maria, Justin's given us a full lowdown on the technical side of the market. What are you seeing on the fundamental side in corporate credit risk?
We're obviously seeing so much demand. And Justin mentioned this a few times too about how tight credit spreads are. We monitor these spread levels on a historical basis, turn them into percentiles. And in IG, for example, spreads have only been tighter something like 20 to 25% of the time, depending on how far back you go. We typically take this data back to 1994. So that's a perfect question, right? Like, well, what's the view on credit risk, given how tight spreads are? Are the technicals kind of hiding some sort of imbalance on the fundamental side? And I would say probably the answer is no. At a very high level, we're not seeing major imbalances in corporate credit fundamentals. And that's to say, for example, specifically, we don't see a single sector where there's excessive leverage and that is highly entrenched within consumer fundamentals for it to present kind of a big macro risk. If anything, some of the telltale signs that we would normally see at the end of cycles that have led into severe recessions, they're not there. Normally, there's a speculative phase of a bull market, for example, where earnings are weak and borrowers are just continuing to borrow, taking on disproportionate amounts of debt. That hasn't happened. Leverage has been stable, and there's not a lot of demand for debt. A lot of the Fed surveys show that it's not just because banks have pulled back on lending, it's because there's no demand for it right now, given where rates are. C-suites have approached this environment pretty conservatively. That's actually not something that would have happened historically. Interest expense, I think, is an even more interesting story because interest rates have been going up. You would expect that for the economy as a whole, for non-financial corporates, their interest expense should be going up. But actually, interest income is rising more than interest expense. So that's happening because there's a lot of deposits still in the system, a lot of cash that large companies are sitting on, and they're earning attractive yields. So in the aggregate, actually, net interest expense is falling. So that means that the ratio of cash flow to interest expense at a very aggregate level is at the best level we've seen since the 1960s. But there's a big but in this data, and that is that it's aggregate data from the Fed's financial accounts. And some of the listeners might know this as the flow of funds. So it adds up everything. It sort of puts together highly levered companies that maybe don't have as much cash, along with the Apples and the Microsofts and the just very large tech companies that have a lot of cash holdings. So under the surface, we need to keep in mind that there is a lot of dispersion. We looked at specifically the S&P 500, the large caps, versus the S&P 600, the small caps. And we found that on a kind of year-over-year basis, we are seeing interest expense increasing at a much higher rate for the smaller companies. Interest expense as a percentage of the cash flow for the smallest companies has increased from something in the tune of about 15% to 28%. So it is eating up cash flows in the corporate credit market. It's just you need to know where to look. You need to know where the sensitivities and the vulnerabilities are, and understand that we're looking at a much more fragmented credit landscape than we were last year.
Justin, you mentioned earlier that you've been watching developments in the credit curves. So explain a little bit more about what that means and what you are seeing.
One of the biggest themes that we have seen, right, is what's going on in the 10s, 30s credit curve. They're really near the recent flat levels historically. And when I say flat, it's really meaning that the incremental spread an investor receives from investing from 30 years versus 10 years. And that's decreased materially, right? So, the two major factors really are one from the demand side and one from the supply side. I think on the demand side, you have a lot of long liability investors, that's pension funds and insurance funds typically, that require long duration assets to match their liabilities. But I think the second factor, which is just as important and impactful, is from the supply side. And that's where we've seen that dearth of 30-year issuance, and really that aforementioned hesitancy from companies to issue longer dated maturity debt at these elevated levels has really caused that reduction in 30-year supply. So you've kind of got two things working towards each other here. Strong demand, not a lot of supply, and so it's brought those credit curves flatter in the 10s, 30s part of the curve. But I do think another interesting theme that's going on in the curve is a little bit shorter, and it's been kind of, I think, less impactful so far, but it's gaining momentum, is that traditional IG investors like asset managers, mutual funds, index funds, they are starting to focus a little bit more in buying that 7 to 10 year maturity cohort. And one, because of what we just talked about, the flatness in that 10s 30s curve. If 30s are getting a little bit rich, then arguably 10s could potentially look attractive. If you extrapolate everyone's belief that not only treasury rates going to go lower, but really more importantly, you're going to start to see treasury yield curves steepen or uninvert. That's going to bring back that nice roll down effect that we typically see in investment grade corporates. So positioning yourself for that 7 to 10 year maturity bucket starts to align your views on what's going on in the yield curve. So those are two things I think that are pretty thematic within credit curves.
Just as a follow-up, Justin, do you think this trend is going to continue?
There's a real push and pull right now in the corporate market. And I'd say that when I look at hedge funds and macro funds, they're definitely selling 30-year risk overall, right? Given that flatness of the credit curve. The liability-driven investors are still buying those long-duration assets. Again, there's not a lot of long-duration assets around there, and it's really more part of their mandate, and they just really aren't available. So right now, there's a very healthy market flow, if you will, a balance of buyers and sellers of that 30-year risk. And I think overall, though, that's going to keep credit curves flat in the long end. As for the short end, until we really start to see U.S. Treasury front-end yields move lower and really start to see the short end of the curve steepen or uninvert, we're going to continue to kind of trade more flattish there, right? I think there'll still be support for corporate spreads overall, but you have to take a step back and realize that there's now, I believe, over $6 trillion of cash parked in money market funds, given how attractive those yields are. So we really need to see normalized curves in order to see that cash deployed back into the short end of investment grade corporates and start to see that credit curve steepen.
Maria, how much can history teach us about possible performance as we are likely heading into an ease sometime later this spring?
It's interesting. Justin kind of hit upon some of these topics too, with respect to when we might expect, long end yields to start to go down. It's essentially that's going to be tied to when's the Fed going to start easing, which is at this point a moving target. I would say the market for the most part was really of the belief, and so were we, that the Fed would start cutting interest rates sometime around March. But of course, the probability distribution around that is very wide, meaning it could be March, it could be May. I would say now we're probably narrowing in on June because of how much the Fed has been pushing back on the start of the easing cycle. And so we need to kind of think about, what if we are in a pause for much longer than people expect? And when do we get to the easing part where suddenly rates are going down and there's a duration benefit for investment grade bonds? So let's look at the performance, right, of high quality corporates in an environment where the Fed is on hold. What happens then? Rates are generally more stable historically when the Fed is on hold. They're not moving rates up and down. And so we see interest rates somewhat range bound, which is what we're looking at now. And that opens the door for investment grade corporates to deliver exactly what they're meant to provide from a total return standpoint, which is stable income. Now, in this environment, we actually just recently published a piece to show graphically what it means in a pause and an easing environment. And in this environment where we're in a pause, historically, investment grade corporate monthly returns have averaged about 1% monthly, which is 12 to 13% annualized. And then you can compare that to, say, high yield during Fed pauses, which still deliver positive annualized returns. But those returns are now more in the range of 8 to 9% on average, because what happens is at the end of the Fed pause, we typically see that the Fed is gearing up to start delivering rate cuts because now there's weakness in the environment. So the more credit beta, higher sensitivity get caught in that environment as it's turning over into a weaker economy. So then the Fed eventually does turn to rate cuts. Now, investment grade credit has the potential to not only deliver those stable coupons, but then also benefit from rates declining because the Fed is easing and because economic concerns trigger a broader flight to safety. And then to Justin's point, that is the point where you start to see curves normalize once the Fed starts lowering interest rates at the front end faster than what we're seeing in the rally at the long end. Now, sometimes the deterioration in the macro environment can be severe enough where investment grade spreads widen in that environment, which does offset some of the benefit from duration. But even taking into account periods where this happened, particularly like in 2008, right? I mean, this was really a crisis. The Fed was delivering very, very big rate cuts, but the macro environment and particularly market liquidity was at that point very fragmented. And so investment grade spreads widened a lot. Even taking into account an extreme situation like that, investment grade corporates still managed to pull through with a 6 to 7% average annualized positive return when the Fed is easing. Compare that to riskier markets like equities and leveraged loans, the outcome there is losses. So for us, it seems like in the next two phases of the Fed and their monetary policy stance, whether they're on hold or easing, you have a good sort of risk-adjusted return story in the investment grade market that sort of merits some allocation to it from a variety of different investors.
Justin, taking all this into account, as the head of the sector team, where are you finding relative value? What are you avoiding? What are your picks and pans right now?
Starting with probably financials versus industrials, I think we really kind of favor financials relative to industrials. If you think about financials, it's banks and insurance, but I think more specifically, comfortable and looking at the big six banks for some relative value. I don't think we've seen the last of the regional bank underperformance or headlines. So I think we're on the margin of avoiding that cohort at the moment. I'd like to see more of the potential CRE stresses, in the market play out and how that might affect some of the deposit issues that we saw earlier last year before really increasing any type of material exposure there. However, I think the large U.S. domestic banks have been through a large wave of primary issuance. And we talked about supply earlier, and I think once you get that supply out of the way, it really allows the market to digest those new bonds and not really seeing that headwind of supply the rest of the year in large form. I think that's a positive technical. I think more on the fundamental side, they have very strong capital positions. And I think they've shown their deposit strength vis-a-vis the regional banks. And so I think they have potential to outperform industrials. So switching to ratings, how we look at the triple B as a single A cohort within industrials, I look for marginal compression there where triple B's compressed to single A's. Now, again, for the last 2+ months, we've really seen that compression come with triple B's tightening versus single A's. I think what we're going to start to see here is actually single A's widen. And that's going to help the compression here between triple Bs. And a lot of that's going to be primary issuance picking up in a lot of the higher quality names, whether it's M&A financing or just larger cap structures that issue various maturities along their credit curve. And also they tend to be more liquid single A corporates. So just kind of giving a little bit of a roadmap how we see some of that compression playing out for the next couple of months.
Maria, in conclusion, what is your outlook for investment grade corporate bonds right now and in credit in general?
I think because we don't see any really major imbalances in the system, we are kind of still 50-50 teetering on whether there's a recession or not. But obviously investment grade corporates, by design, they're of higher quality. So as Justin has talked about, there's just a lot of demand. So you sort of have to be constructive on investment grade while still acknowledging that spreads are just very tight. So, and I mentioned earlier on a historical basis, spreads are somewhere in the 25th percentile of historical valuations. And the reality is that spreads are a mean reverting risk premium because business cycles go up and down. And so eventually we're likely going to see some spread widening. But for the near term, I think there seems to be quite a bit of support. That said, I think a lot of what Justin talked about is touching on this idea that you still have to be selective to some extent. I mean, I know that there are a lot of concerns, particularly for investors who are diversified, broadly allocated to other sectors, especially like large cap equities. There are concerns out there about concentration in any single company, the possibility that one company's performance might be driving an entire index. And I'm sure that's going to resonate with anyone who's invested in the broader large cap indexes. The reality is the same can be true of investment grade corporate allocations that are passive. In the investment grade corporate bond index, the top 100 issuers out of over 1,000 issuers make up 50% of the amount of investment grade bonds outstanding. Then you have some bonds that trade at almost zero spreads, which basically means you're not getting any additional yield over treasuries in that particular bond for that issuer. But then there are bonds that offer 3 to 4%, more yield than treasuries. So that could be attractive, or maybe there's a reason for that. Maybe that's a potential for a downgrade. I mean, no matter what, I think, what Justin is really touching upon is that there is a lot of nuance in the investment grade space. Where do you want to be positioned? Which sectors do you want exposure to? And while one can have kind of a general outlook of being constructive in investment grade, there's going to be pockets where you want to be positioned. There's going to be pockets that are going to underperform in a more fragmented environment. And so these are kind of the way that we think about risks, downside risks, upside risks, and we encourage others to take the same type of approach, even in a high quality space.
Well, thank you both. This has been a great high-level look at the investment grade corporate market. But before I let you go, first, Justin, do you have any final takeaways for our listeners?
Maria brought up a lot of good points, especially on the fundamental side. I think the takeaway when we're kind of combining some of the technicals that I'm talking about and the fundamentals she's talking about is both can change for bearish reasons. And I think that's important here to stay liquid and nimble in this environment. If Maria's fundamental view kind of plays out or we get some widening, although the fundamental view is strong, I think we want to be in a position to take advantage of that opportunity as spreads widen. Although I've talked a lot about the technicals and why we should be comfortable with IG credit right here, it's important to keep in mind that, the incremental spread you're getting paid for unsecured corporate risk is historically very low. Credit risk spread, if you look at it as a percentage of all-in yield that you're buying when you buy a bond, is at 17%. That last troughed at 15% right before the financial crisis. So not saying that you shouldn't be buying credit here. It's more about just recognizing that you are assigning very little credit risk at the moment to corporate bonds when you look at the all-in yield and how much credit risk is being attributed to that all-in yield, right, at 17%. Now, the counter view to that, and I think, again, why we're seeing such support for the sector is that all-in yields are historically attractive. To set some goalposts here, consider that 30-year corporate credit spreads are at essentially the 0th percentile over the last 20 years, while on the other side, 30-year yields are nearly at the 90th percentile when we look back on 2 decades. So again, you're not necessarily being paid in the credit spread, but the all-in yield remains attractive. And I think that's really why we've seen such a pickup in ETF and derivative trading. Overall, given Maria's fundamental view, and I think some of the technicals that look like they'll be steady for quite a while, it looks quite investor friendly for the near future. But again, staying liquid and nimble here, I think is extremely important.
Wise advice. Maria, any last words from you for our listeners today?
My only last words are to thank our listeners as usual. Thank you so much for reading our research, and we really hope this has been informative. And I hope you'll invite me back, Jay.
Of course, you guys are always welcome. Now, before we wrap, as I said, we have a listener question to share. This question was addressed to Karthik Narayanan, the head of our structured credit team for Guggenheim Investments and a guest on our last podcast. Here's the question. Why do you tend to stay away from asset-backed securities categories like credit card ABS or car loan ABS? And here is Karthik's answer. It's just for relative value reasons. The consumer ABS markets like credit cards or autos or unsecured consumer loans, these tend to be more widely followed and have lower duration and lower yields. There's not much of a complexity premium for these subsectors, because the collateral is well understood by the market and the deal structures are standardized. We tend to focus on less widely followed sectors of ABS, where there is a larger complexity premium and better overall reward for the risk of owning fixed income spread product. Well, thanks, Karthik. That makes total sense to me. Now, thanks again to everyone who has joined us for our podcast. If you like what you are hearing, please rate us 5 stars. And if you have any questions for Justin or Maria or any of our other podcast guests, please send them to macromarkets@guggenheiminvestments.com, and we will do our best to answer them on a future episode or offline. I'm Jay Diamond, and we look forward to gathering again for the next episode of Macro Markets with Guggenheim Investments. In the meantime, for more of our thought leadership, visit guggenheiminvestments.com/perspectives. So long.
Important notices and disclosures. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future returns. All mutual and exchange-traded funds are required to report their returns after fees are deducted, but Barron's calculates returns before any 12b-1 fees are deducted in order to measure manager skill, independent of expenses beyond annual management fees. Similarly, sales charges aren't included in the calculation. Each fund's performance is measured against all of the other funds in its LSEG Lipper category, with a percentile ranking of 100 being the highest and 1 the lowest. The result is then weighted by asset size relative to the fund family's other assets and its general classification. If the family's biggest funds do well, it boosts its overall ranking. Poor performance in its biggest funds hurts its ranking. To be included, a firm must have at least 3 funds in the general equity category, 1 world equity, 1 mixed equity such as balanced or a target date fund, 2 taxable bond funds, and 1 national tax-exempt bond fund. Single sector and country equity funds are factored into the rankings as a general equity. All passive index funds are excluded, including pure index, enhanced index, and index-based, but actively managed ETFs and smart beta ETFs, passively managed but created from active strategies, are included. Finally, the score is multiplied by the weighting of its general classification as determined by the entire Lipper universe of funds. The category weightings for the 1-year results in 2023 were general equity 37.7%, mixed asset 22%, world equity 16.1%, taxable bond 20.1%, and tax-exempt bond 4%. The numbers are then added for each category and overall. The shop with the highest total score wins. Copyright 2024 Dow Jones & Company, all rights reserved. Read a fund's prospectus and summary prospectus if available carefully before investing. It contains the fund's investment objectives, risks, charges, expenses, and other information which should be carefully considered before investing. Obtain a prospectus and summary prospectus if available at guggenheiminvestments.com or call 800-820-0888. S&P bond ratings are measured on a scale that ranges from AAA, highest, to D, lowest. Bonds rated BBB- and above are considered investment grade, while bonds rated BB+ and below are considered speculative grade. Stock markets can be volatile. Investments in securities of small and medium capitalization companies may involve greater risk of loss and more abrupt fluctuations in market price than investments in larger companies. The market value of fixed income securities will change in response to interest rate changes and market conditions, among other things. Investments in fixed income instruments are subject to the possibility that interest rates could rise, causing their value to decline. High-yield securities present more liquidity and credit risk than investment-grade bonds and may be subject to greater volatility. Investors in asset-backed securities, or ABS, including mortgage-backed securities, or MBS, and collateralized loan obligations, or CLOs, generally receive payments that are part interest and part return of principal. These payments may vary based on the rate loans are repaid. Some asset-backed securities may have structures that make their reaction to interest rates and other factors difficult to predict, making their prices volatile, and are subject to liquidity and valuation risk. CLOs bear similar risk to investing in loans directly, such as credit, interest rate, counterparty, prepayment, liquidity, and valuation risks. Loans are often below investment grade, may be unrated, and typically offer a fixed or floating interest rate. This podcast is distributed or presented for informational or educational purposes only and should not be considered a recommendation of any particular security, strategy, or investment product, or as investing advice of any kind. This material is not provided in a fiduciary capacity, may not be relied upon for or in connection with the making of investment decisions, and does not constitute a solicitation of an offer to buy or sell securities. The content contained herein is not intended to be and should not be construed as legal or tax advice and/or a legal opinion. Always consult a financial, tax, and/or legal professional regarding your specific situation. This podcast contains opinions of the author or speaker, but not necessarily those of Guggenheim Partners or its subsidiaries. The opinions contained herein are subject to change without notice. Forward-looking statements, estimates, and certain information contained herein are based upon proprietary and non-proprietary research and other sources. Information contained herein has been obtained from sources believed to be reliable, but are not assured as to accuracy. No part of this material may be reproduced or referred to in any form without express written permission of Guggenheim Partners LLC. There is neither representation nor warranty as to the current accuracy of nor liability for decisions based on such information. Past performance is not indicative of future results. Guggenheim Investments represents the investment management businesses of Guggenheim Partners LLC. Securities are distributed by Guggenheim Funds Distributors LLC.